What are the general powers and duties of the Bureau of Internal Revenue? The powers and duties of the BIR in general are the following. 1. Assess and collect national internal revenue taxes, fees, and charges. Enforce or forfeitures, penalties, and fines connected with the assessment and collection of taxes, fees, and charges. Execute judgment in all cases decided in its favor by the CDA and the ordinary courts, and effect and administer supervisory and police powers conferred upon it by the NIRC and other laws. Section 2. What are the powers of the Commissioner of the Internal Revenue? 1. Interpret tax laws. 2. Decide tax cases. 3. Obtain information and to summon, examine, and take testimony of persons. 4. Make assessments and prescribe additional requirements for tax administration and enforcement, notwithstanding any law requiring the prior authorization of any government, agency, or instrumentality. 5. Prescribe real property. 6. Make arrests and seizures. 7. Delegate powers. 8. Assign and reassign internal revenue officers involved in excise tax functions to establishments where articles subject to excise tax are produced or kept. 9. Impose duties on certain officers. 10. Suspend business operations of taxpayers. Are the powers of the Commissioner of Internal Revenue delegable? As a general rule, the CIR may delegate the powers vested in him to any subordinate official with a rank equivalent to a division chief or higher. NIRC Section 7. However, the following powers cannot be delegated. RICA. Power to recommend the promulgation of rules and regulations by the Secretary of Finance. Power to issue rulings of first impression or to reverse, revoke, or modify an existing ruling of the Bureau. Power to compromise or abate any tax liability, except matters which may be compromised by the Regional Evaluation Board and National Evaluation Board. And 4. Power to assign or reassign internal revenue officers to establishments where articles subject to excise tax are produced or kept. Interpreting tax laws and deciding tax cases. Discuss the Commissioner's power to interpret tax laws. The power to interpret the provisions of the Code and other tax laws shall be under the exclusive and original jurisdiction of the Commissioner, subject to review by the Secretary of Finance. NIRC Section 4. What are BIR rulings? What is required to make a BIR ruling or first impression a valid one? BIR rulings are administrative opinions issued by the Commissioner of Internal Revenue interpretative of a provision of a tax law. They are the best guess of the moment and incidentally often contain such well-considered and sound law. But the courts have held that they do not prevent an entire change of front at any time and are merely advisory, sort of an information service to the taxpayer. ABAN, Law of Basic Taxation. A BIR ruling of first impression, ruling which has no precedent yet, to be valid must not be against the law, and it must be issued only by the Commissioner of Internal Revenue. Philippine Bank of Communications versus CIR. Discuss the power of the Commissioner to decide tax cases. The Commissioner has the power to decide 1. Disputed assessments. 2. Refunds of internal revenue taxes, fees, or other charges. 3. Penalties imposed in relation thereto. 4. Other matters arising under this code or other laws or portions thereof administered by the Bureau of Internal Revenue is vested in the Commissioner. Note, these are subject to the exclusive appellate jurisdiction of the Court of Tax Appeals. Section 4 of NARC. What is the power of the Commissioner to obtain information and to summon, examine, and take testimony of persons? in ascertaining the correctness of any return, or in making a return when none has been made, or in determining the liability of any person for any internal revenue tax, or in collecting any such liability, or in evaluating tax compliance, the Commissioner is authorized: 1. To examine any book, paper, record, or other data which may be relevant or material to such inquiry. 2. To obtain on a regular basis from any person other than the person whose internal revenue tax liability is subject to audit or investigation, or from any office or officer of the national and local governments, government agencies and instrumentalities including the BSP and GOCCs, any information. 3. To summon the person liable for tax or required to file a return, or any office or employee of such person, or any person having possession, custody, or care of the books of accounts and other accounting records, or any other person to appear before the Commissioner or his duly authorized representative, and to produce such books, papers, records, or other data, and to give testimony. 4. To take such testimony of the person concerned under oath as may be relevant or material to such inquiry. And 5. To cause revenue officers and employees to make a canvass from time to time of any revenue district or region, and inquire after and concerning all persons therein who may be liable to pay an internal revenue tax, and all persons owing or having the care, management, or possession of any object with respect to which a tax is imposed. Note: nothing listed above shall be construed as granting the Commissioner the authority to inquire into bank deposits other than as provided for in Section 6, letter F of the Tax Code. How is the power of the Commissioner to obtain information and to summon, examine, and take testimony of persons is strengthened by the Train Law. Train Law amended Section 5 of the NRRC by providing that the Cooperative Development Authority shall submit to the Bureau a tax incentive report, which shall include information on the income tax, value-added tax, and other tax incentives availed of by cooperatives registered and enjoying incentives under RA 6938, as amended, provided that the information submitted by the Cooperative Development Authority to the Bureau shall be submitted to the Department of Finance and shall be included in the database created under RA number 10708, otherwise known as the Tax Incentives Management and Transparency Act, TIMTA, NIRC as amended by Train Law, Section 5, letter B. May the bank deposits, peso, and foreign currency of an individual taxpayer be disclosed by a commercial bank to the CIR in connection with a tax investigation being conducted by revenue officials without violating the relevant bank secrecy laws? Explain. No. As a general rule, bank deposits of an individual taxpayer may not be disclosed by a commercial bank to the Commissioner. As exceptions, Section 6 of the NIRC provides that the Commissioner is authorized to inquire into the bank deposits of 1. A decedent to determine his gross estate. 2. Any taxpayer who has filed an application for compromise of his tax liability by reason of financial incapacity to pay his tax liability. Note: his application shall be considered unless and until he waives in writing his privilege under RA 1405 Bank Secrecy Law or under other general special laws, and such waiver shall constitute the authority of the Commissioner to inquire into the bank deposits of the taxpayer. NIRC Section 6, letter F. 3. A specific taxpayer or taxpayers subject of a request for the supply of tax information from a foreign tax authority pursuant to an international convention or agreement on tax matters to which the Philippine is signatory or a party of, provided that the information obtained from the banks and other financial institutions may be used by the Bureau of Internal Revenue for tax assessment, verification, audit, and enforcement purposes. RA 121, Section 3. How is the authority of the Commissioner to prescribe real property values exercised? In exercising this authority, the following shall be observed. 1. Mandatory consultation with both private and public competent appraisers before division of the Philippines into zones. 2. Prior notice to affected taxpayers before the determination of fair market values of the real properties. 3. Publication or posting of adjustments in zonal value in a newspaper of general circulation in the province, city, municipality concerned. 4. The basis of valuation and records of consultation shall be public records open to the inquiry of any taxpayer. 5. Zonal valuation shall be automatically adjusted once every 3 years. NIRC as amended by Train Law, Section 6, letter E. Can the CAR delegate to the Chief of the Accounts, Receivable, and Billing Division the issuance of a demand letter for tax deficiency assessment which contains denial of the taxpayer's request for reconsideration? Yes, the act of issuance of the demand letter by the Chief of the Accounts, Receivable, and Billing Division does not fall under any of the exceptions that have been mentioned as non-delegable above. Furthermore, Section 6 of the Tax Code provides that the authority to make tax assessments may be delegated to subordinate officers. Oceanic Wireless Network versus Commissioner of Internal Revenue, 2005. Non-retroactivity of rulings. Rulemaking authority of the Secretary of Finance. What is the rulemaking authority of the Secretary of Finance? The Secretary of Finance, upon the recommendation of the Commissioner, shall promulgate all needful rules and regulations for the effective enforcement of the provisions of the Code. Section 224. What are the specific provisions to be contained in the rules and regulations of BIR? The following shall be contained in the rules and regulations of the BIR. 1. The time and manner in which Revenue Regional Directors shall canvass the respective revenue regions for the purpose of discovering persons and property liable to national internal revenue taxes, and the manner in which the list and records of taxable persons and taxable objects shall be made and kept. 2. The forms of labels, brands, or marks to be required on goods subject to an excise tax, and the manner in which the labeling, branding, or marking shall be effected. 3. The conditions under which and the manner in which goods intended for export, which, if not exported, would be subject to an excise tax, shall be labeled, branded, or marked. 4. The conditions to be observed by revenue officers respecting the institution and conduct of legal actions and proceedings. 5. The conditions under which goods intended for storage in bonded warehouses shall be conveyed thither, their manner of storage, and the method of keeping the entries and records in connection therewith, also the books to be kept by revenue inspectors and the reports to be made by them in connection with their supervision of such houses. 6. The conditions under which denatured alcohol may be removed and dealt in the character and quantity of denaturing material to be used, the manner in which the process of denaturing shall be effected, so as to render the alcohol suitably denatured and unfit for oral intake, the bonds to be given, the books and records to be kept, the entries to be made therein, the reports to be made to the Commissioner, and the signs to be displayed, and the business by the person for whom such denaturing is done, or by whom such alcohol is dealt in. 7. The manner in which revenue shall be collected and paid, the instrument document or object to which revenue stamps shall be affixed, the mode of cancellation of the same, the manner in which the proper books, records, invoices, and other papers shall be kept, and entries therein made by the person subject to the tax, as well as the manner in which licenses and stamps shall be gathered up and returned after serving their purposes. 8. The conditions to be observed by revenue officers respecting the enforcement of Title 3, imposing a tax on the state of a decedent and other transfer mortis causa, as well as on gifts and such other rules and regulations which the Commissioner may consider suitable for the enforcement of the said Title 3. 9. The manner in which tax returns, information, and reports shall be prepared and reported, and the tax collected and paid, as well as the conditions under which evidence of payment shall be furnished the taxpayer, and the preparation and publication of tax statistics. And 10. The manner in which internal revenue taxes, such as income tax, including withholding tax, state and donors taxes, value-added tax, other personage taxes, excise taxes, and documentary stamp taxes shall be paid to the collection officers of the Bureau of Internal Revenue or through duly authorized agent banks, which are hereby deputized to receive payments of such taxes and the returns, papers, and statements that may be filed by the taxpayer in connection with the payment of the tax, provided, however, that notwithstanding the other provisions of this code prescribing the place or filing of returns and payment of taxes, the Commissioner may, by rules and regulations, require that the tax returns, papers, and statements that may be filed by the taxpayers in connection with the payment of the tax. Is BIR's act of issuing rules and regulations in the exercise of judicial or quasi-judicial capacity? What's the question? Is BIR's act of issuing rules and regulations in the exercise of judicial or quasi-judicial capacity? No, BIR's act of issuing rules and regulations is not in the exercise of any judicial or quasi-judicial capacity. It is in the exercise of BIR's quasi-legislative or rule-making powers, Clark Investors and Locators Associations versus Secretary of Finance, 2015. Note, this petition for certiorari under Rule 65 of the Rules of Civil Procedure is not the proper remedy against act of issuing rules and regulations of the Secretary, Clark Investors and Locators Association versus Secretary of Finance. Income tax. Definition of income tax. It is a tax on all yearly profits arising from property, professional, trades, or offices, or as a tax on a person's income, emoluments, profits, and the like. LG Electronics Philippines versus Commissioner of Internal Revenue, December 3, 2014. What is the nature of income tax? Income tax is a kind of tax levied upon the privilege of receiving income or profit. It is an excise tax and not a tax on property. Discuss the general principles of income taxation under NIRC. Citizens of the Philippines residing therein. Taxable on all income derived from sources within and without the Philippines. Non-resident citizens. Taxable on income only derived from sources within the Philippines. Individual citizens of the Philippines who is working and deriving income from abroad as an overseas contract worker. Only on income from sources within the Philippines, provided that a seaman who is a citizen of the Philippines and receives compensation abroad as a member of the complement of a vessel engaged exclusively in international trade shall be treated as an overseas contract worker. Alien individual, whether a resident or not of the Philippines, taxable only on income derived from sources within the Philippines. Domestic corporation, taxable on all income derived from sources within and without the Philippines. Foreign corporation, whether engaged or not in trade or business in the Philippines, taxable only on income derived from sources within the Philippines. What are the income tax systems in the Philippines? 1. Global tax system, a tax system which views indifferently the tax base and generally treats in common all categories of taxable income of the individual. It taxes all categories of income except certain passive incomes and capital gains. 2. Scheduler tax system, a tax system whether the income tax treatment varies and is made to depend on the kind of category of taxable income of the taxpayer. It itemizes the different income and provides for varied percentages of taxes to be applied thereto. And 3. Semi-schedular or semi-global tax system. A. Global in the sense that all compensation income, business or professional income, capital gain and passive income, not subject to final withholding income tax, and other income, not subject to final tax, are added together to arrive at the gross income. After deducting the total allowable deductions from business or professional income, capital gain and passive income, and other income not subject to capital gains tax and final tax, in the case of corporations as well as personal and additional exceptions, in the case of individual taxpayer, and the taxable income, example, gross income, less allowable deductions and exemptions, is subjected to one set of graduated tax rate, if individual, or regular corporate income tax rate, if corporation. Scheduler, in the sense that passive investment income subject to final tax and capital gains from the sale or transfer of shares of stock of a domestic corporation and sale or transfer of real properties remain subject to different sets of tax rates covered by different tax returns. What are the criteria in imposing Philippine income tax? The 3 principles being used as criteria are the following. Citizenship principle, where a citizen taxpayer is subject to income tax on his worldwide income from sources within and without the Philippines, if he resides in the Philippines, or only on his income from sources within the Philippines if he qualifies as a non-resident citizen. Residence principle, where an alien is subject to Philippine income tax because of his residence in the Philippines, but only on his income from sources within the Philippines. Source principle, where an alien is subject to Philippine income tax because he derives income from sources within the Philippines. Enumerate the types of Philippine income tax. The types of Philippine income tax are the following. 1. Graduated income tax on individuals, Section 24. Regular or normal corporate income tax on corporations, Section 27. Minimum corporate income tax on corporations, Section 27. Special income tax on certain corporations, private educational institutions, or foreign currency deposit units and international carriers. 5. Capital gains tax, CGT, on sale or exchange of unlisted shares of stock of a domestic corporation classified as a capital asset, Section 24, letter C. CGT, or capital gains tax on sale or exchange of real property located in the Philippines classified as capital asset, Section 24, letter D. Final withholding tax, FWT, on certain passive investment income, Section 28. Number 8. Final withholding tax, FWT, on income payments made to non-residents or individual or corporation. 9. Fringe benefits tax, FBT, Section 33. 10. Branch profit remittance tax, BPRT, Section 28. 11. Improperly accumulated earnings tax, IAET, Section 29. 12. Gross income tax, GIT, Section 27, letter A. Taxable period. What are the different taxable period under the NRIC? The taxable periods are the following. Calendar period. An accounting period which starts from January 1 to December 31. Taxable income shall be computed on the basis of the calendar year. If the A. Taxpayer's accounting period is other than fiscal year. B. Taxpayer has no annual accounting period. C. Taxpayer does not keep books. Or D. Taxpayer is an individual. NIRC Section 43. Fiscal period. An accounting period of 12 months ending on the last day of any month other than December. NIRC Section 22, paragraph Q, which is allowed only for corporations. And 3. Short period. An accounting period where income is computed on the basis of a period less than 12 months when the A. Taxpayer other than an individual with the approval of the Commissioner changes his accounting period from fiscal year to calendar year, or from calendar year to fiscal year, or from one fiscal year to another. Section 47. B. Taxpayer dies, applicable to the decedent's final personal income tax, covering the beginning of the taxable year until his death, the income of his state, and the state tax return. Section 90. Corporation is newly organized. D. Corporation is dissolved. And E. Tax period is terminated by the Commissioner by authority of law. May a corporation change its taxable period? Yes. A taxpayer, other than an individual, with the approval of the Commissioner, may change the basis of computing its net income from fiscal year to calendar year, from calendar year to fiscal year, or from one fiscal year to another fiscal year. Section 47. Kinds of taxpayer. Enumerate the different kinds of taxpayer. The different kinds of taxpayers are the following. 1. Individual taxpayer. 2. Corporation. 3. Partnership, including business partnership and general professional partnerships. 4. States and trusts. 5. Co-ownership, Section 22 and 23. What are the classifications of individual taxpayers? Citizens, resident citizens, RC, or non-resident citizens, NRC. Aliens, resident aliens, RA, or non-resident aliens, NRA. Non-resident aliens engaged in trade or business in the Philippines, NRAETB, or non-resident aliens not engaged in trade or business in the Philippines, NRANETB. Special class of individual employees. Minimum wage earners, MWES, Section 22, letter HH, Section 24, NRIC. B. Those aliens individuals employed by regional or area headquarters, HRQ, and regional operating headquarters, ROHQ, or municipal companies, by offshore banking units, and by petroleum service contractor and subcontractor, Section 22, subsections C, D, and E. Who are the citizens of the Philippines? The following are the citizens of the Philippines. Those who are citizens of the Philippines at the time of the adoption of the 1987 Constitution, February 2, 1987. Those whose fathers or mothers are citizens of the Philippines. Those born before January 17, 1973, effectivity of 1973 Constitution, of Filipino mothers who elect Philippine citizenship upon reaching the age of majority, and those who are naturalized in accordance with law. 5. Citizens of the Philippines who marry aliens shall retain their citizenship unless by their act or omission they are deemed under the law to have renounced it. Constitution Article 6, Section 4. Who is a resident citizen? A citizen of the Philippines who stayed in the Philippines or stayed outside the Philippines for less than 183 days during the taxable year. Valencia and Rojas, Income Taxation. What is meant by residence for taxation purposes? This is the permanent home, the place to which, whenever absent for business or pleasure, one intends to return. Who is a non-resident citizen? The following are considered as non-resident citizens. 1. A citizen of the Philippines who works and derives income from abroad and whose employment thereat requires him to be physically present abroad most of the time during the taxable year. 2. A citizen of the Philippines who establishes to the satisfaction of the Commissioner the fact of his physical presence abroad with a definite intention to reside therein. 3. A citizen of the Philippines who leaves the Philippines during the taxable year to reside abroad, either as an immigrant or for employment on a permanent basis. 4. A citizen who has been previously considered as non-resident citizen and who arrives in the Philippines at any time during the taxable year to reside permanently in the Philippines shall likewise be treated as a non-resident citizen for the taxable year in which he arrives in the Philippines with respect to his income derived from sources abroad until the date of his arrival in the Philippines. Section 22. What does the phrase most of the time means? The phrase most of the time means at least 183, 365 plus 2 days. RR number 1-79, Section 2. His presence abroad, however, need not be continuous. No, citizens who work outside the Philippines for at least 183 days in taxable year due to a contract of employment with a Philippine employer are not considered non-resident citizens because they are not considered employed abroad. Who is an overseas contract worker? An overseas contract worker, OCW, refers to a Filipino citizen employed in foreign country who is physically present in a foreign country as a consequence of his employment thereat. His salaries and wages are paid by an employer abroad and not borne by any entity or person in the Philippines. Note, to be considered an OCW, he must be duly registered as such with the Philippine Overseas Employment, or POEA, and 2, he must have a valid working contract to work abroad. When is a seaman considered as an OCW? A seaman is considered as an OCW provided the following requirements are met. A citizen of the Philippines. 2. Received compensation for services rendered abroad as a member of the complement of a vessel. 3. Such vessel is engaged exclusively in the international trade. 4. He must be duly registered as such with the POEA. And 5. He has a valid overseas employment certificate and a seafarer's identification record book or seaman's book issued by the Maritime Industry Authority or Marina. Who is a resident alien? A resident alien is an individual whose residence is within the Philippines and who is not a citizen thereof. An alien may be considered a resident of the Philippines for income tax purposes if he is not a mere transient or sojourner. 2. He has no definite intention as to his stay in the Philippines. His purpose is of such nature that an extended stay may be necessary for its accomplishment, and to that end, the alien makes his home temporarily in the Philippines. When is a residency lost? An alien who has acquired residence in the Philippines retains his status as a resident alien until he abandons the same and actually departs from the Philippines. Mere intention to change his residence is not enough. Who is a non-resident alien? A non-resident alien is an individual whose residence is not within the Philippines and who is not a citizen thereof. A non-resident alien individual may be engaged in trade or business in the Philippines if the aggregate period of stay in the Philippines exceeds 180 days for each calendar year. Or, number 2, not engaged in trade or business if the aggregate period of stay in the Philippines does not exceed 180 days for each calendar year. Special class of individual employees. Who is a minimum wage earner? MWE. A minimum wage earner refers to a worker in the private sector who is paid the statutory minimum wage, or to an employee in the public sector with compensation income of not more than the statutory minimum wage in the non-agricultural sector where he is assigned. Section 22, paragraph HH. He is exempt from income tax. The exemption also covers the holiday pay, overtime pay, night shift differential pay, and hazard pay earned by the minimum wage earner. RR number 8-2018, Section 2. Note, hazard pay shall mean the amount paid by the employer to minimum wage earners who were actually assigned to danger or strife-torn areas, disease-infested places, or in distressed or isolated stations and camps, which expose them to great danger or contagion or peril to life. Any hazard paid to MWEs which does not satisfy the above criteria is deemed subject to income tax and consequently withholding tax on the said hazard pay. RR number 11/2018, dated January 31, 2018. What is meant by statutory minimum wage? It shall refer to the rate fixed by the Regional Tripartite Wage and Productivity Board, as defined by the Bureau of Labor and Employment Statistics, BLES, of the Department of Labor and Employment, DOE. RR number 11/2018, Section 6. Who are the special class of individual aliens who enjoys preferential tax treatment under the NIRC? Those alien individuals employed by regional or area headquarters, RHQ, and regional operating headquarters, ROHQ, of municipal companies, by offshore banking units, and by petroleum service contractor and subcontractor, shall enjoy a preferential 15% tax rate based on their gross income, provided that the same tax treatment shall apply to Filipinos employed and occupying the same positions as those of aliens employed in RHQ, ROHQ, OBU, and PSCS. Section 25, CDE. Note, the preferential income tax rate under subsection D, C, and E of Section 25 of the Tax Code as amended shall no longer be applicable without prejudice to the application of preferential tax rate under existing international tax treaties, if warranted. Thus, all concerned employees of the RHQ, ROHQ, OBU, and PSCS shall be subject to the regular income tax rate under Section 24. Corporations. Define corporations for income tax purposes. The term corporation shall include partnerships, no matter how created or organized, joint stock companies, joint accounts, associations, or insurance companies. It does not include general professional partnerships and a joint venture of consortium formed for the purpose of undertaking construction projects or engaging in petroleum, coal, geothermal, and other energy operations pursuant to an operation or consortium agreement under a service contract with the government. What are the classifications of corporate taxpayers? Corporate taxpayers may be domestic corporation, DC, Section 27, foreign corporations, FC, Section 28, either resident foreign corporations or non-resident foreign corporations, Section 28, letter A, and Section 28, letter B. What is a domestic corporation? The term domestic, when applied to a corporation, means created or organized in the Philippines or under its laws. What is a foreign corporation? A foreign corporation is one which is not domestic. What is a resident foreign corporation? A resident foreign corporation is a foreign corporation engaged in trade or business within the Philippines. Note, in order that a foreign corporation may be regarded as doing business within a state, there must be continuity of conduct and intention to establish a continuous business, such as the appointment of local agent and not one of a temporary character. Commissioner of Internal Revenue versus British Overseas Airways. It involves any other act or acts that imply a continuity of commercial dealings or arrangements and contemplate to that extent the performance of acts or works or the exercise of some of the functions normally incident to and in the progressive prosecution of commercial gain, or the purpose and object of the business organization. Q is an offline international air carrier selling passage ticket in the Philippines to a general sales agent considered as a resident foreign corporation? Yes. Doing business includes appointing representatives or distributors operating under full control of the foreign corporation, domiciled in the Philippines, or who, in any calendar year, stay in the country for a period totaling 180 days or more. Hence, an offline carrier has appointed in the Philippines through whom it sells or offers for sale any air transportation is undoubtedly doing business or engaged in trade or business in the Philippines, therefore considered resident foreign corporation. Air Canada versus Commissioner of Internal Revenue. What is a non-resident foreign corporation? A non-resident foreign corporation is a foreign corporation not engaged in trade or business within the Philippines. Section 22, letter L. What is meant by a joint venture and consortium? It is generally understood to mean an organization formed for the execution of a single transaction and is thus of a temporary nature. While a corporation cannot generally enter into a contract of partnership unless authorized by law or its charter, it has been held that it may enter into a joint venture, which is akin to a particular partnership. Felix Mining Corporation versus Commissioner of Internal Revenue. What are the essential factors to constitute a joint venture? The following are the essential factors to constitute a joint venture. 1. Each party making a contribution not necessarily of capital, but way of services, skill, knowledge, material, or money. 2. Profits must be shared among the parties. 3. Profits must be joint propriety interest. 4. Right of mutual control over the subject matter of the enterprise. And 5. Usually, there is a single business transaction. Partnership. What is a partnership? It is a contract whereby two or more persons bind themselves to contribute money, property, or industry to a common fund with the intention of dividing the profits among themselves. Civil Code Article 1767. Discuss the tax liability of partnership. Partnerships, no matter how created or organized, except general professional partnerships and joint ventures or consortiums engaged in construction or energy-related operations, are taxable as corporations. Section 22, letter B. What is a general professional partnership? A general professional partnership, GPP, is one formed by persons for the sole purpose of exercising their common profession, no part of the income of which is derived from engaging in any trade or business. NIRC Section 22, letter B. Discuss the tax liability of GPP, or General Professional Partnership. A GPP shall not be subject to income tax. Persons engaging in a business as partners in a GPP shall be liable for income tax only in their separate and individual capacities. Each partner shall report as gross income his distributive share, actually or constructively received, in the net income of the partnership. Note: for purposes of computing the distributive share of the partners, the net income of the GPP shall be computed in the same manner as a corporation. As such, a GPP may claim either the itemized deductions allowed under Section 34 of the Tax Code or in lieu thereof. It can opt to avail of the optional standard deduction, OSD, allowed to corporation in claiming the deductions in an amount not exceeding 40% of its gross income. Once availed, individual partner is not allowed to claim further deduction from his distributive share and not allowed to avail the 8% income tax rate option, since share from GPP is already net of costs and expenses. Under RMC number 1, 2018, dated January 4, 2018, income payments to partners of general professional partnership is subject to 8% creditable withholding tax. Define the term estate for income taxation purposes. Estate is composed of all properties, rights, and obligations, including those properties, earnings, or obligations that have accrued thereto since the opening of the succession. Note: the status of the estate is determined by the status of the decedent at the time of his death, so an estate as an income taxpayer can be a citizen or an alien. In the case of a non-resident decedent who at the time of his death was not a citizen of the Philippines, only that part of the entire gross estate which is situated in the Philippines shall be included in his taxable estate. Section 85 of NIRC. Discuss the tax liability of an estate. When a person who owns property dies, the following taxes are payable under the provisions of the income tax law. 1. Income tax for individuals to cover the period beginning January to the time of death, Section 24. And 2. State income tax if the estate is under administration or judicial settlement. Note: state income tax under Section 60 of the NIRC is different from the imposition of estate tax. While the first is in the nature of income tax, the latter is a transfer tax imposed on the privilege to transfer the properties of the deceased to his heirs. Moreover, the exemption amounting to $20,000 for estates and trusts is removed under trained law. Define the term trust for income taxation purposes. A trust is a right of property, real or personal, held by one party for the benefit of another. Guy v. Court of Appeals. Discuss the tax liability of an estate. A trust is taxable on 1. Trust income to be accumulated. 2. Trust income to be distributed currently by the fiduciary to the beneficiaries. 3. Income collected by guardian of an infant which is to be held or distributed as the court may direct. And 4. Trust in which the fiduciary may, at his discretion, either distribute or accumulate the income. Section 60. Is employees' trust or benefit plans exempt from income tax? Yes. Employees' trust or benefit plans normally provide economic assistance to employees upon the occurrence of certain contingencies, particularly old age, retirement, death, sickness, or disability. It provides security against certain hazards to which members of the plan may be exposed. It is an independent and additional source of protection for the working group. It is evident that tax exemption is likewise to be enjoyed by the income of the pension trust. Otherwise, taxation of those earnings would result in a diminution of accumulated income and reduce whatever the trust beneficiaries would receive out of the trust fund. This would run afoul of the very intendment of the law. When is there co-ownership? There is co-ownership whenever the ownership of an undivided thing or right belongs to different persons. Is a co-ownership considered as a separate taxable entity? It depends. It is 1. Not taxable when the activities are limited merely to the preservation of the co-owned property, but co-owners are liable for income tax in their separate and individual capacities. 2. Taxable when the income of the co-ownership is invested by the co-owners in business, thereby creating an unregistered partnership. Owner versus Commissioner of Internal Revenue. Is the dissolution of the co-ownership by agreement subject to the division of property to capital gains tax? No. The transfer of title to co-owners is not a sale, barter exchange, or other disposition contemplated by law, subject to the imposition of the tax. The act of partitioning a commonly owned property to each co-owner should not be treated as a taxable event, as it is nothing more than terminating the co-ownership by making each co-owner owner of specific identifiable portion of or unit of the property. BIR ruling number 153-99. Definition and nature of income. Define income. Income means all wealth that flows into the taxpayer other than a mere return of capital. It includes the form of income specifically described as gains and profits, including gains derived from the sale or other disposition of capital assets. Note, it is an amount of money coming to a person or corporation within a specified time, whether as payment for services, interest, or profit from investment. Unless otherwise specified, income means cash or its equivalent. Hermando Conwy v. Court of Appeals. Is the increase in the value of the property considered as income? No. It is merely an unrealized increase in capital. Increase of appreciation in the value of the property is not even an accrual of income to the taxpayer prior to the realization of such appreciation through sale or conversion of the property. When is income considered to have been received? Income is received not only when it is actually handed to a person, but also when it is merely constructively received by him. Limpan Investment versus Commissioner of Internal Revenue. Discuss the doctrine of constructive receipt of income. Income which is credited to the account of or set apart for a taxpayer, and which may be drawn upon him at any time, is subject to tax for the year during which credit is set apart, although not then actually reduced to possession. To constitute receipt, in such sense, the income must be credited to the taxpayers without any substantial limitation or restriction as to the time or manner of payment, or condition upon which payment is to be made. What are the requisites for income to be taxable? The following are the requisites of income to be taxable. There must be a gain or profit. 2. The gain or profit must be realized or received actually or constructively. And 3. It is not exempted by law or treaty from income tax. What are the considerations in determining whether an income is taxable? The different considerations are the following. Existence of income. Income tax applies only when there is income, gain, or profit. Realization of income. A mere increase in the value of the property is not income but merely an unrealized increase in capital. No income is derived nor a loss incurred by the owner until after the actual sale or other disposition of the property in excess of its cost. Recognition of income. The taxable income shall be computed upon the basis of the taxpayer's annual accounting period, in accordance with the method of accounting regularly employed in keeping the books of such taxpayer. But if no such method of accounting has been so employed, or if the method employed does not clearly reflect the income, the computation shall be made in accordance with such method as in the opinion of the Commissioner clearly reflects the income. Section 43. What is the cash method of accounting? Under the cash method of accounting, cash receipts and disbursements method, income is realized upon the receipt of cash or its equivalent, including those constructively received, such as deposits for the taxpayer's account by customers, but not including gifts or donations. What is the accrual method of accounting? Under the accrual basis method of accounting, income is reportable when all the events have occurred that fix the taxpayer's right to receive the income, and the amount can be determined with reasonable accuracy. Thus, it is the right to receive income and not the actual receipt that determines when to include the amount in gross income. Gleanable from this notion that the following requisites of accrual method of accounting: 1. That the right to receive the amount must be valid, unconditional, and enforceable, not contingent upon future time. 2. The amount must be reasonably susceptible of accurate estimate. And 3. There must be a reasonable expectation that the amount will be paid in due course. Philippine Synthetic Fiber versus Court of Appeals. What are the tests in determining whether income is earned for tax purposes? Realization test. There is no taxable income unless income is deemed realized. Revenue is generally recognized when both conditions are met. A. The earning process is complete or virtually complete, and B. An exchange has taken place. Manila Mandarin Hotel versus CIR. Number 2. Claim of right doctrine or doctrine of ownership, command, or control. A taxable gain is conditioned upon the presence of a claim of right to the alleged gain and the absence of a definite unconditional obligation to return or repay. CIR versus Javier. 3. Economic benefits test or doctrine of proprietary interest. Taking into consideration the pertinent provisions of law, income realized is taxable only to the extent that the taxpayer is economically benefited. Severance test. Income is recognized when there is separation of something which is of exchangeable value. Eisner versus Macomber. All events tests. Requisites. Fixing of a right to income or liability to pay, and availability of the reasonable accurate determination of such income or liability. Q. Isabella Cultural Corporation ICC incurred professional fees for legal services that pertain to the 1984 and 1985. ICC did not claim deductions for said expenses in 1984 and 1985 since the cost of the services was not yet determinable at that time. It claimed deductions only in 1986 when ICC received the billing statements for said services. BIR, however, contends that since ICC is using the accrual method of accounting, expenses for professional services that accrued in 1984 and 1985 should have been declared as deductions from income during the years, and the failure of ICC to do so bars it from claiming said expenses as deduction for the taxable year. A. The expenses should have been claimed as deductions in 1984 and 1985 for a taxpayer using the accrual method. The accrual of income and expense is permitted when all events test has been met. The all events test requires the right to income or liability be fixed, and the amount of such income or liability be determined with reasonable accuracy. However, the test does not demand that the amount of income or liability be known absolutely, only that a taxpayer has at his disposal the information necessary to compute the amount with reasonable accuracy. The amount of liability does not have to be determined exactly. It must be determined with reasonable accuracy. The propriety of an accrual must be judged by the facts that a taxpayer knew or could reasonably be expected to have known at the closing of its books for the taxable year. Accrual method of accounting presents largely a question of fact, such that the taxpayer bears the burden of proof of establishing the accrual of an item or income or deduction. From the nature of the claimed deductions and the span of time during which the firm was retained, ICC can be expected to have reasonably known that the retainer fees charged by the firm as well as the compensation for its legal services. The failure to determine the exact amount of the expense during the taxable year, when they could have been claimed as deductions, cannot thus be attributed solely to the delayed billing of these liabilities by the firm. For one, ICC, in the exercise of due diligence, could have inquired into the amount of their obligation to the firm, especially so that it is using the accrual method of accounting. For another, it could have reasonably determined the amount of legal and retainer fees owing to its familiarity with the rates charged by their long-time legal consultant. CIR vs. Isabella Cultural Group. What are tax-free exchanges? Tax-free exchanges refer to those instances enumerated in Section 40, letter C, number 2 of the National Internal Revenue Code, NIRC, of 1997 that are not subject to income tax, capital gains, documentary stamp tax, and or value-added tax, as the case may be. There are two kinds of tax-free exchange. 1. Transfer to a controlled corporation. No gain or loss shall be recognized if property is transferred to a corporation by a person in exchange for stock or unit of participation in such corporation, of which as a result of such exchange, said person alone or together with others, not exceeding 4 persons, gains control of said corporation. In 2. Merger or consolidation. No gain or loss shall be recognized if in pursuance of a plan of merger or consolidation, a corporation which is a party to a merger or consolidation exchanges property solely for stock in a corporation which is a party to the merger or consolidation, or B. A shareholder exchanges stock in a corporation which is a party to the merger or consolidation solely for the stock of another corporation also a party to the merger or consolidation. Or C. Security holder of a corporation which is a party to the merger or consolidation exchanges his securities in such corporation solely for stock or securities in another corporation, a party to the merger or consolidation. Section 40. Define merger or consolidation for purposes of exchange of property. Merger or consolidation shall be understood to mean 1. The ordinary merger or consolidation, or 2. The acquisition by one corporation of all or substantially all the properties of another corporation solely for stock undertaken for a bona fides of business purpose and not solely for the purpose of escaping the burden of taxation. Situs of income taxation. Sources of income subject to tax. What are the classification of income as to source? 1. Gross income and taxable income from sources within the Philippines. Gross income and taxable income from sources without the Philippines. And income partly within or partly without the Philippines. What are the items of gross income treated as a gross income from sources within the Philippines. They are 1. Interest derived from sources within the Philippines on bonds, notes, or other interest-bearing obligations of residents, corporate or otherwise. 2. Dividends received from A. Domestic corporation. B. Foreign corporation provided at least 50% of its gross income is from sources within the Philippines, and such gross income must be for the 3-year period ending with the close of the taxable year preceding the declaration of such dividends. Note, it is limited only in an amount which bears the same ratio to such dividends as the gross income of the corporation for such period derived from sources within the Philippines bears to its gross income from all sources. 3. Compensation for labor or personal services performed in the Philippines. 4. Rentals and royalties from property located in the Philippines or from any interest in such property. 5. Gains, profits, and income from sale or of real property located in the Philippines. And 6. Gains, profits, and income from the sale of personal property as treated as derived entirely from sources within the country if the property was purchased within and sold without the Philippines, or purchased without and sold within the Philippines. No, gain from the sale of shares of stock in a domestic corporation shall be treated as derived entirely from sources within the Philippines regardless of the place where the shares were sold.